Our biggest thing that we do is first from an understanding. So most people that when working with us understand, and I take them through this, 5 to 7 year journey, right? And this is probably about 10% of the help, because probably after I talk for about 2 minutes, the client's kind of starting to think about something else. But the general is that just like anything else, insurance, it goes through cycles. Right now, maybe that's a 4 year, 5 year cycle, right? Right now we're in the height of everything. We've had also some pretty big factors with our 2021 or 2020 scenario in the country, and everything. So we have this perfect storm where everything's high.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Matt Sutika is the Chief Insurance Officer for Obie Insurance. Obie specializes in habitational and multifamily insurance. Matt, welcome to the show.
Hey, thank you for having me.
Hey, man, pleasure's mine. Same 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell us, where did you start? Where are you now? And how did you get there?
Yes, I can. I started as a captive state farm agent in Indianapolis. I left that to grow an insurance company for a real estate firm called Century 21, if the listeners are familiar with that. So grew that, which got me into the real estate and insurance combo. And then most recently in 2020, moved on from just doing the smaller real estate to more getting into the large multifamily across the country. So that was my journey from, small captive to, working with a real estate company to now working with syndicators and people purchasing real estate.
Interesting. That's and are you guys multi assets, or is it just all multifamily?
Multi-asset. So we have a couple of departments. We can do the 1, 2, 3 unit, what I call like mom and pop rentals or large schedules of portfolios. We all over the country. So we have a department that does that. You actually, the 1 to 4 unit, you can go to our website and get an instant quote and bind yourself if you want. Any of the 50 states, 1 to 4 units, which is nice. And then anything from the 5 to what's called like 75 units in that space. Also, what's called like lesser's risk, which is like your shopping malls or your big commercial buildings. We have kind of the medium market, and then we have the 75 and up, which is your larger, multifamily. So we have 3 different departments, all 50 states. So technically, from 1 unit all the way on up, we can help you. Anything I say building related and insurance, we're probably your go-to.
Right, man. That's really, really intriguing. Walk us through, if you had the ideal client, right? The ideal person that came to work with you, what would they do? And then why would they do those things?
I think my ideal is partnership. So I love whether, you have 1 unit or you are buying apartments all over the place. I love the feel, and you asked me my journey earlier of why I got into the real estate and then why I got into, doing larger multifamily and things like that. Is it was the people. I enjoyed, somewhat of my industry can be treated as a commodity. The Geico and Flow from Progressive have created this, save $1 in 15 minutes thing. And so I really like the people. So that's always my answer is, if you come to me as a partner where you want my expertise, help, and you just really want to make insurances there at your closing, that's my ideal client. Those who, want to go out to 17 different brokers and shop it around, or those who don't want to really, treat you as anything more than that, you're just the insurance guy for a quote. That's probably not a good, mix, and the reason why that's important is there's going to be times where we do save you money, but there's also going to be times where you really need us to go that extra mile or cut something here or do something here or stay till midnight so you can close the next morning. And that's where partnerships really, come into play, right? On the easy stuff, you can go to anybody, but a lot of times, as we know in the real estate space, closings don't, just go perfectly, 45 days from the time you get your purchase agreement. Like there's a lot of stuff that goes, and you really want someone in your boat with you that can, be a part of the journey.
Yeah, that's absolutely intriguing. And I think you're absolutely right. One of the things that we see a lot right now is that people are either, or we see that people are underinsured. How does that happen? And then why do you think they got there?
Yeah, I mean, the simple answer is a lot of people who are underinsured probably are your cash buyers. If you right now, if you have a lender on your, your asset, most likely that's a first layer of protection. The lender is going to make sure that you are not underinsured, that you have a lot of the coverages, and that we're providing them. Most of the deals, I'm working right with the lender or their consultant to make sure the insurance is in place. So I don't see that as much on new purchases unless it's a cash deal or they have a lender who just doesn't care, just basically like, hey, just, get me a certificate, which is a very rarity. And then you also see it once someone's owned the asset potentially for a little while and a refi happens. That's where I really see the person who's underinsured. But if everyone does their job, the lender and the insurance person, uh, you should be covered correctly, especially nowadays. These loans are very well protected and they really do double check and triple check to make sure the insurance is correct.
How does someone end up being underinsured during a refinance?
A refi, we'll use a real live examples. You're an insurance broker. I'm an insurance broker. I did the first insurance and I had to go through all the lender requirements and I had to insure it at $20 million, for that asset. Right. And I did it all. It was all on the appraisal and everything like that. All of a sudden you're going for a refi and you go and a local bank comes into play and they're really not either looking at things over or they really aren't as strict with the requirements.
Mm.
And that owner goes to you, right, and says, hey, quote this out for me. And you quote it at $10 million, right? Just that's what you quoted it at. You're trying to, because, what's to say that owners are like, hey, I want to save money. That's probably why they went to another insurance person, right? And so you do it at 10 million to save them all this money. You send over the certificates to that new lender who is maybe a local bank or something like that. And that local bank just approves it. They're not really looking at it or doing the due diligence that first lender did at purchase. And now you have a $10 million insured building instead of 20. Now everything went correct, right? Like the lender approved it. The insurance person did what you asked, cut your insurance in half, but now you are underinsured. So that's a just off the hip example, but things like that can happen. And it really comes down to when the checks and balances go out of whack. And also in that same scenario, you changed insurance brokers,
Mm.
which caused the problem, right? If we would have did the ideal scenario, that owner would have just came back to me and said, Matt, I got to reduce costs. How can we do that? Right. And then we give some options. And then we might have the underinsured conversation and we might see if the bank is okay with it. But at least then that insured knows what they're getting into. Hey, I can move you to 10. I think you should be at 20. We know that this bank will approve 10, but just let you know you're insuring your place for half. So if this thing burns down, only 10 million is coming, not 20. But at least then you are making a business decision as an owner compared to a price decision that ends up being a poor business decision, if that makes sense.
It really does. It really does. One of the things that we're seeing in the market right now is, and it's been happening here for probably the last year or more, but it's a hardening of insurance rates. How are you helping? I mean, because you're really, forgive me when I say this, because obviously you're very well educated, very well trained in your space, but you're an intermediary in the sense that you don't have control directly. Matt does not say, okay, here's the insurance rates, right? You can only say, here's what our insurers are willing to insure your property for, and this is what's going to cost you. How are you helping your clients deal with the hardening of the market? And then what can people be doing to maybe absorb some of that or make it easier as we move forward?
Yeah. So, our biggest thing that we do is first from an understanding. So most people that when working with us understand, and I take them through this, 5 to 7 year journey, right? And this is probably about 10% of the help because probably after I talk for about 2 minutes, the client's kind of starting to think about something else. But the general is that just like anything else, insurance, it goes through cycles. Right now, maybe that's a 4 year, 5 year cycle, right? Right now we're in the height of everything. We've had also some pretty big factors with our 2021 or 2020 scenario in the country and everything. So we had this perfect storm where everything's high. Back in 2018, 2019, insurance was free, or that's how it felt. It was so cheap, right? We were getting all these amazing rates. And the only real problem is that if people, when they're going out to look at a new risk, they're still looking at 18, 19 rates. And they're like, this was used to be 300 a door in Texas. and they're not seeing that journey to the next era. It's like the same person who complains that gas is not 99 cents anymore. They don't understand this whole like hot topic of inflation and other things, right? So that's the general understanding. The next thing is, as I mentioned, for a partner, if I'm doing a ton of deals for you, we have ways to reduce premium from my end. Maybe it comes out of my side, maybe it doesn't, but I have ways to help a partner, and I'm willing to do that when I'm doing 1, 2, 3, 4, 5 deals. Like I mentioned, you want someone in the boat with you at that midnight hour that can maybe move the needle if have to. We're a willing partner both ways. We're not just here to, leech on, write a policy for you and make money. Like if you're hurting a little bit, we might hurt a little bit. And I think that's the give or take in the relationship. And then the last thing is, we're willing to put the effort in. At the end of the day, like you mentioned, we do go out to the carriers and we are subject to their rates. But what we're willing to do is we might go out to 500 carriers for a client to just do everything we can to even get, the smallest reduction. And then also, the last thing, which I'll bring up is that, we do have a lot of premium in these markets and we do have really good relationships. So I do have a few silver bullets, a few favors on the back end with these particular carriers that if I have to, ask, or if I do ask, they usually help me out. Now that might not move the needle from 100K to 50K, but I might ask for a favor and get it from 100 to 95 because I just placed X amount with them the previous week. So there's a lot of facets. Just overall, to end with, we are 100% in this space, which does give us the advantage due to all those things I mentioned.
What's an annual escalator on average we should be budgeting in our underwriting for insurance? Let's multifamily's hot, so let's talk multifamily.
Yeah, so in I do kind of a mixed allocation, right? So I think in your when things are priced well, you're anywhere from like the 5 to let's call it 9%. And I'm talking about the large multifamily, right? In markets like right now, you're looking a lot more in the like 8 to 17 range. We try to keep everything, if we physically can, under 12. I mean, that is always our goal. Carriers willing, right? If I had my way, these carriers would just do a 0 every year. But so that's kind of where we're at. So if you do like kind of a split average and estimated somewhere in that 7 to 10 range, you'd probably be pretty close looking over at like a 5-year scale. Now in the single family, smaller stuff, you can probably get away more in like the 3 to 7 mark. There's small premiums, not as big of a boost, but the large multifamily also too, I don't want to bore the listeners here, but there is a big difference between renewals in Texas and Florida compared to Indiana or Illinois, from coastal, there's a lot of factors going on. So individually, those are other things we would discuss. You're in Texas or you're in Tennessee, you're in a high crime area, there's 6 hurricanes in your area last year. Like, what do you think is going to happen? Right. You had 17 claims, so those are the overalls. And then individually, we're talking to our clients based off their, individual risk and kind of what they can expect. And a lot of our clients reach out mid-year and kind of ask us for some updates as they're projecting out for the upcoming year. We're happy to do that.
Right. So the number I heard there was on an average, if you said, hey, you need to stick this in a spreadsheet, obviously location dependent, but anywhere from 8 to 17% annually is where we need to be kind of targeting. And like you said, you try to keep it under 12. So even if we use 12, that number's higher than what we've been using, in the last 5 years. That certainly is and on a $100,000 policy, that can add up fast. So that's
absolutely. And, and those are the numbers right now for the market we're in 2022 here. But I do think, again, like I mentioned with the, still looking at 18, 19 rates, that probably held true back then, maybe even, I remember in 19, actually on renewals, sometimes I was lower than the previous year. So you're going to get that. And that's why I think if you use that blended around the 7-ish, 7, 8, you're going to be pretty good and accurate. Also, lender requirements have skyrocketed compared to what they were a few years ago. So that's a factor that people don't really equate in there as well. Is it's not just is insurance rates going up, but it's also the lender requirements and what they're wanting covered. And, instead of a 5 million umbrella, now they want a 15 million umbrella. Instead of, 180 days of indemnity, now they want 365. Instead of 12 months rent, now they want 2 years of rent. So some of it is lender driven as well, or bank driven, right? That's moving up the needle a little bit as well. That it always looks like the insurance person is just going higher, but sometimes it's the lender requirements as well.
Well, yeah, certainly. And that just stands to hold or makes sense, because if the lender is requiring more of the insurance company, hey, you guys need to take on more risk, then the insurance company is going to say, well, okay, we're going to offset that risk by increasing the cost of the policy to the borrower, or to the insured. So, I mean, that all those things just kind of stack up, and that's really, really interesting. Matt, thanks for taking the time to break down kind of the state of the insurance industry, what you guys are doing and how you're doing it. It's certainly fascinating. And again, thank you for kind of giving us some tips and clues on what to do with a hardening market and how we should be underwriting, what numbers we could be plugging in. I know obviously those are location dependent, but using that, like you said, 7% plus is a number that we should at least be sticking in our spreadsheets for annual rent, or not rent escalator, but annual cost increases on our insurance. So that's absolutely fantastic. Let's jump here into the final 4 questions. What is one tool or resource, think digital, think software, that you find you can't live without?
Outlook. I am a Outlook. I will hold out until Microsoft stops producing that. But everyone laughs at me because we are a Gmail as a company, and I am like the one Microsoft Outlook that they have to pay for monthly, and I'll never give it up unless they make me.
That's funny, man. I love that. Great. Question number 2. What is one mistake you could help our listeners avoid, and then how would you avoid it?
The number one mistake is not talking to your insurance person before you do due diligence and you give your report to what you want the seller to provide you before you go under contract. I think that is often missed, and it's an opportunity to lower costs and also find out a lot about that. The 5-second on it is that, if you can get the loss runs and the current policies during that period of due diligence, and you put that in there, one, you see what the loss history was. Was there a bunch of murders and slip and falls and, crazy GL claims? Was there a bunch of fires? And then also on the current policies, you actually really get to see if the OMs were legit when they were putting their, T12 number in. So those 2 things are key. And I see a lot of people miss that.
That's a great one. That's a great point. I love that. So you're saying before you take a look at an asset, you're like, hey, I love this. I'm about to put a letter of intent in. That's when they should be calling you, before they send that LOI.
Yeah, for the LOI. And even if you get your LOI accepted, you have that due diligence period before you're under contract, and you tell them what you want. Say, I want copies of those 5-year loss runs, and I want copies of current insurance policies. Insurance really is a good data driver for what happened, and can really show you a lot about the financials and all kinds of things, right? And you can really see if you were on the fence and all of a sudden you see 6 murders and a couple fires, you might pull out before you go under contract. It could really switch. You also know you're about to write a big check for insurance if you see that too, right? So we can adjust your numbers real fast too.
Right. No, that's absolutely fantastic. I love that. When it comes to investing in the world, what's one thing you're doing right now to make the world a better place?
Right now for me, just top of the head, is I have a 4-month-old, and that is my concentration of it. There, that's I guess a selfish one, but I have to name drop my 4-month-old pen at least on every podcast, or the wife won't give me allowance this week.
No, that's fantastic, man. Good luck to you getting any sleep. Last question for you, Matt. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
So social media is probably the easiest. I'm just under my name, Matt Sutika, Sutika. LinkedIn, Facebook. Feel free to send me a message. You can go to obierisk.com and get a hold of me. And then my cell phone's 312-877-2692. Feel free to text or call me. And then, of course, email Matthew@obierisk.com.
Thanks, Matt. Appreciate your time today.